Hello everybody and welcome to this video lecture on Chapter 5, Inventories and Cost of Sales. Now I hope that those terms already sound familiar to you because we were first introduced to those terms in Chapter 4. It may look a little bit different, right? Because of that term cost of sales. Well, I just want you guys to know that that term cost of sales means the exact same thing as cost of goods sold or COGS. And in fact, I noticed that many of you guys, when you were working on your team project trying to calculate the gross profit ratio or gross margin ratio, you found that there was a line item on the financial statements that said cost of sales, and a lot of you weren't sure what that was. Well, that's the same thing as cost of goods sold. So the two terms are used interchangeably. Okay, so like I said, these are terms that we learned already in Chapter 4, and now in Chapter 5 we're going to build on those concepts and discuss some additional complexities related to inventories and cost of sales or cost of goods sold. So before we get into building on those concepts that we're learning, that we've already learned, I want to go back and review those concepts, make sure that we have a good understanding of what we learned in Chapter 4 so that now we can build on it in Chapter 5. So a few key questions, or I want to review the key terms and concepts. So questions to review those key terms and concepts are here. So first we're going to say, what is inventory? What type of account is inventory? And which financial statement has inventory on it? Okay. Then we're going to switch gears. What is cost of goods sold? What type of account is cost of goods sold? And which financial statement has cost of goods sold on it? So I'm going to give you guys a minute to, on your own, try to remember and reflect on those, the answers to those questions. Make sure you really have a good understanding. Okay, so hopefully you've had a chance to write down some answers to those questions. Now let's see if you got them right. First of all, what is inventory? Well, inventory is product that the company owns with the intent of selling it. So like in a grocery store, all of this stuff that you see in a store shelf is the company's inventory because they have it there with the intention of selling it to their customer. Okay? Now the type of account that inventory is an asset. And as we know, the two requirements of an asset are that the company owns it and that it's expected to provide a future benefit. Well, the future benefit of inventory is that it's held with the intent to sell. So once they sell it in the future, they start the process of making money. And making money, of course, provides a benefit to the company. And the financial statement that inventory is on, well, because it's an asset and a balance sheet gives us a summary of the company's assets, liabilities, and equity, we're going to see inventory on the balance sheet. But then once the goods are sold, the asset goes away, right? Because now the asset is with the customer. And so we have to take that inventory off of our balance sheet and move it to a new account called cost of goods sold. So cost of goods sold is the cost, meaning the amount that you bought it for, of the goods that you sold. And as you can see, I have them here in a shopping cart, which indicates that these goods are no longer inventory. They've been taken off the store shelf. They're no longer available for sale. They've been sold. They're in a shopping cart ready to go home with the customer. So goods that have been sold are your cost of goods sold. And the type of account is it's an expense account. And an expense, as we've learned previously, is goods and services used up in the process of generating revenue. Well, when we sold these goods, we generated revenue. But again, these goods didn't materialize out of nowhere. We had to buy them in the first place. So when we now have used them up, meaning they're gone, we've used this inventory, it's all done, that cost of the goods that we sold is the expense. It's showing that that inventory has been used up in the process of a sale. And because cost of goods sold is an expense account, it is on the income statement, because the income statement is basically a summary of how much money we made, and how much money we made is revenues minus expenses. So that hopefully is a summary of these accounts. Hopefully we know them well, because we're going to be continuing talking about these accounts throughout this chapter. Now in chapter 5, we learn some additional terms and concepts that I want to make sure that we really understand so we can move forward. And this new term that we learn is cost of goods available for sale. I think it was mentioned in chapter 4. I didn't focus too much on it in the homework or in the class activity, but it was mentioned in chapter 4. But I want to really make sure we get a good handle of it now in chapter 5. So cost of goods available for sale is everything that the company had available to sell during an accounting period. Again, that could be a month, that could be a year, however long the accounting period is, what in total was available for sale. Now, we know throughout the period things are getting, we're purchasing inventory, we're selling it over and over and over again, but overall, what is the most that they could have sold in that period? Okay. So now we're going to talk about what two things go into cost of goods available for sale. How do we know what they had available? Well, the two things that go into it are this. The beginning inventory, which means what did the company have available on their store shelves at the beginning of the accounting period? So in other words, what was left over from the last period that they didn't sell? It's still there on the shelf. So that's their beginning inventory. And then to that, we add any additional purchases of inventory. So here you can see this lady, she's stocking more inventory on the shelves. That's because they purchased more inventory, so they're adding that to the cost of goods available for sale. Sorry if you can hear my son in the background here. He's here to share his thoughts on cost of goods available for sale as well. Just ignore him if you can. All right, so the next thing we have to consider is what two things could happen to cost of goods available for sale. So if this right here is everything that we had available to sell during the period, one of two things could happen to it. Either we sold it, in which case it goes to cost of goods sold, or if we didn't sell it, it's still sitting on our store shelves, and we call that ending inventory. Whatever we didn't sell by the end of the period is our ending inventory. It then becomes the beginning inventory for the next accounting period. Okay? So again, this is what we call the flow of inventory. We start with our beginning inventory, what we had on our shelf. We add in any additional purchases of inventory throughout the accounting period. That gives us our total cost of goods available for sale, everything we had available during the period. And then, out of everything we had available that we could have sold, either we sold it and it's cost of goods sold, or we didn't sell it and it's ending inventory. Okay? So the math on this is basically tells you that your beginning inventory plus your purchases also equals your cost of goods sold plus your ending inventory. Okay? So now let's do another review of chapter 4, journal entries. If I buy a can of Coke at a cost of $1 on account, then sell it at a price of $1.50 on account, what is the journal entry to record the purchase? What is the journal entry to record the sale? And what is the gross profit? Now again, you guys should already know how to do this from chapter 4, so I'm going to give you a little bit of time to go ahead and write down those journal entries to get some practice. All right, so hopefully you took that time to practice, and now let's see if you got those answers right. So if I buy a can of Coke at a cost of $1 on account, I have inventory increasing, so I'm going to debit my inventory to show my asset increasing. And then because I bought it on account, it means I haven't paid for it yet. I'm going to pay for it in the future. That's a liability called accounts payable. And when my liability is increasing, it's a credit. Oh, excuse me. So now, as far as the amount to use, we talked last time in chapter 4 about cost versus price. Well, our cost, what we paid for it was $1, and our price, what we sold it for, is $1.50. So when you're talking about the purchase entry, your purchase is always going to be at cost, what you paid for it. So that's why I'm using the dollar here and here, because this is our purchase entry. Now when I go to sell it, hopefully you all remember that there are two parts to a sales entry, the revenue part and the expense part. And that's due to the matching principle that says we have to, if anytime there's revenue, we have to match it with the related expense. Because this can of Coke that we sold didn't materialize out of nowhere. We had to buy it first. So we had to use something up in order to be able to sell it. So the revenue part of the transaction, because our customer bought it on account, they haven't paid us for it yet. They owe us the money, so it's accounts receivable. And the other side of the entry is sales, excuse me, which is a revenue account showing that we provided goods or services to our customer. And the amount we use for the sales part of the transaction or the revenue part of the transaction is the price of $1.50. That's what we sold it for. That's the value of the goods that we sold, and that's what our customer is going to be paying to us, $1.50. The other part of a sales entry is the expense side, and that's showing the part that was used up. Well, now the inventory that we had here that we purchased for $1 has gone away. So now we're going to credit our inventory, showing our inventory going down for $1. And we have cost of goods sold, showing the expense of that inventory being used up in the process of the sale, in the process of generating revenue. And for that part of the entry, again, we're going to use cost, which is what we paid for it. And we have to do that because if our inventory came on the books at $1, we have to also take it off of our books for $1. Okay? And again, that term cost of goods sold, we're focusing on the cost. And again, the cost is what we bought it for, so it's $1, and that's why we use $1 here. Okay? So those are our basic purchase and sales journal entries that we learned from chapter 4. And then, of course, I want to know, well, what is our gross profit? Well, the formula for gross profit is sales minus cost of goods sold equals gross profit. And our sale was $1.50, which was also our price. And our cost of goods sold was $1, which was also our cost. So therefore, our gross profit is 50 cents. Okay. But now let me give you another scenario. What if I buy a second can of Coke at a cost of $1.20? Then I sell a can of Coke for $1.50. What is the cost of goods available for sale? Well, we had our beginning inventory, the first can we bought for $1. Then we have our new purchase, which we bought for $1.20. So now our cost of goods available for sale. Oops, my math is wrong. It's not $2.40, it's $2.20. Let me fix that. Okay. It's $2.20. But now let's complicate things further. What is the journal entry to record the sale? Well, that's a tough one. We'll come back to that answer momentarily.